So interest rate cuts everywhere. That's what you want to see, right? We are right after inflation rate out of the euro area, as well as core PCE indexes out of US. And both of them looks like those gauges are diminishing, so that might be favoring the economy. But inflation reports, even though at the surface looks like those figures are diminishing, underneath may be just unbowed when talking especially about the core of euro area. So you may say, even though those cuts may eventually come after those core gauges getting lower in US and the core of euro area is somewhat flat or even rising slightly, it's not very easy to forecast what may come afterwards. So historically, the final Fed tightening produces anything but a clear-cut direction for stocks. So better careful what you wish for. Right now, the markets are playing for the positive results coming out of the possible ending up a hiking cycle. But what may come next, it's not as rosy as it seems. So I'm very glad to host you today as it's broadcast live. So if you have any questions, just put it in the comments on the chat right under the video. So we are right after an astounding rise on Nasdaq from its lows to highs, and that's exciting time for investors as we see many companies listed on the stock market have recently seen significant gains. So, but what about the breadth of the market? That's what we will talk about today, as the move is not that healthy as it seems. So that's one of the things we'll go through today. So let's begin. All right, economy view. What's today? At first, let's find out what has just economic calendar brought us, as we are right after personal income on US and personal spending alongside the one that many have been waiting for is that core PC price index just has surprised many. Just look at this data. Core PCR price index, when forecasted to get to 0.6% right now, is right hitting 0.3. So it's mainly positive, and that may boost a further growth on either Nasdaq or US 500. Just look at this outstanding pre-market reaction to market of US 100, and that's the catalyst after this publication, and that supposedly may spark the further positivity on the market. Right now, it's a kind of a negation. The bears are stepping in and trying to negate and discount the result of this report, but the main directional move is undoubtedly indicating that we are more likely going upwards than downwards. So that's at first about the elements of US gauges, and right here we have a much more complicated thing for euro area inflation. So Lagarde was waiting to see a sustained downward turn in underlying inflation, and the euro area inflation rate is dropping, but core inflation is absolutely the one that can't stop. And the main difference between the two measures is that the inflation rate for the euro area includes all goods and services, whereas the core inflation rate excludes volatile items such as food and energy. So you may just debate which one the ECB and Lagarde need to watch for when making their possible turns in policy, but inflation rate might be the one that they will look for, but as well as core inflation rate doesn't really drop, it may really become a head scratcher for those analysts behind ECB. So on the one hand, this trajectory may prompt us into a more direction of a eventuality of putting up this putting off the medal, putting the medal of lowering trajectory of hiking interest rates, but on the other hand, this inflation of the core one is something that pushing us still upwards. So this core inflation rate that excluding food and energy is still rising, and that's the one that we need to just assess in really making any outcomes of it and forecasting what may come next. So the March inflation reading adds to the case of additional tightening from the ECB, but right now we don't know that also euro area have some problems with banking sector. That's why we may rather fake it or make it when tightening even further. So for US, we can find some victims of this hiking interest rate policy right now, with Fed lingering issues around inflation and some challenges around securing workers and wage pressure and the fading away of a lot of stimulus. And right now the excess savings drying up, and as the labor market begins to soften later this year, the lack of credit will become even more evident in spending. So right now we may say that everything should be fine. Is just a small sector of the economy, but just remember the thing that around 60 to 70% of small and mid-cap companies are mainly responsible for this GDP growing higher on United States market. That's why we cannot neglect those puppies, those economic puppies, and we need to really have it contained. So we cannot say it's just a one industry, because then all of a sudden things may just go off the rails, and every other single of the puzzle may eventually fall apart. So also we've seen very prominent finding where US 100 were around 25 to over 1/3 of whole market cap of this index is consisted of the largest stocks. Among them there is Nvidia, Microsoft, Google, and Amazon. Whereas Root, that is a Russell 2000 that has a better outlook or the lookout for the breadth of the market and US economy right now. This section is absolutely astounding, and something that may prompt us to wonder what may come out of it. For now, it's a possible harbinger of that especially after getting out of this symmetrical triangle, that right now the very difficult time for this small caps is coming up, and we are nowhere near from beginning another bull run. For now, we are in a tightening mode, even though we are rescuing some banks and just injecting some fiscal drip. It just rather favoring the strongest units rather than the one that are lacking from the excess of capital. So that's exactly what I meant. Banks continue to rely heavily on Fed money, and just look at combined Fed discount window and bank term heavily on Fed money. So right here you can find that the amount of banks that are waiting for this fiscal drip out of Fed is absolutely going through the roof. And for the first time in 18 months, so the Fed has a more immediate risk than inflation. The acute risk is that excessive hawkishness could rekindle bank stress. And the ludicrous thing is that the Fed is going their direction with a literally their eyes blindsided. They are still learning about the full effect of their tightening, and they couldn't really assess how it may look out, even though they have a plenty of best analysts in the world, and they couldn't really assess that inflation is coming up, that it's not transitory, and as well that tightening would have a catastrophic impact on many of those smaller entities. In the meanwhile, China is recouping prior losses, and right now, with the beginning of a year, it's absolutely crushing the scene. China PMI is giving us the outlook for new orders to hit 54 on a gauge that is higher than throughout the recent period since 2021. So it may also inject some positive sentiment on the other markets, but I would say rather that China is much more different market than the Europe and the US, and this time might be the one where this East markets may perform better than US. So if you are just wondering about diversification, you may just wonder some of the countries out of that economies. All right, so market outlook. Let's find out what's going out. All right, so US 100 we've already delivered, but look at SPX. SPX doesn't show any time of any signs of weakness. Right now we are continuing a directional move upside with this possible first stop on the way at 40.70, but on a 4-hour candle, 4-hour interval, we are right now very with a very strong impulse, getting out of this neckline that may resemble to some a neckline of an inverted head and shoulders that is very strong and important technical pattern. So if I may draw the kind of a possible path for SPX, that will be some kind of such as especially with this seasonality favoring stock market upside. Literally for SPX, maybe the seasonality of April is not that favoring as for Nasdaq, as the Nasdaq is mainly surging throughout in April, but SPX should follow anyway, with a possibility of fading this banking crisis, at least for now. The sentiment was that low that we really deserve for another rally forward. So that's about that market outlook. Right now, let's head on to crypto outlook. And very interesting finding out of the Citibank that the bank forecasted 4 to 5 trillion of tokenized digital securities and 1 trillion of distributed ledger technology based trade finances volumes will by 2030. And listen, so cryptocurrencies is just easier to use than any of other assets that are traded just in very restrictive windows of time with very high commissions, and also we don't have any more expensive reconciliation settlement failures waiting for the fax documents or originals to follow by post or investment choice being restricted by operational difficulty in access. Also, we don't have a traditional financial problematic institutions. There are third parties and often collapse, as well as there are no broken but suboptimal, as they are limited by traditional systems and processes. Those assets are really much more efficient to use than the ones that are known from the banking system. So just regulation may change their attitude to cryptocurrencies, and they should be implemented anytime soon. So I would like to also get to know your point of view on the thing in a chat. So don't hesitate to write it down to me. In terms of market movers, let's find out what about economic calendar. And on Friday, we had inflation rate out of France. It was a bit higher than the forecast. So right now, the France may head on a period of a more plateau tendency. But yesterday also we had those PMIs out of China that was a bit lower, but still above neutral levels. And as I mentioned, inflation rate and PCEs from US. In terms of earnings calendar, we had on Thursday this GetDAO. I don't have an updates on that, so I don't know why. Not announced, but all right. So GetDAO should be updated within next trading session. Also, we have a Neogen Corporation that was at 200% surprise. So for this company, it's an absolutely outstanding result. And from Manchester United, we have a negative surprise of EPS. All right, so we are right now heading to a section of trade idea, and on trade idea we will just get on back to US 100, and on US 100 right now we are, as you can find, trying to rebound out of this recent slump that was a correction of the impulse, and right now the possible objective of US 100 will be right at the level of 13.17, where we have a relatively important this ceiling of a week being formed back on 26th of August, and that's what I expect a just temporary halt of a rise, but as a final destination for that move, I do expect we'll hit at least 13.54, and that will maybe be correlated with this Fed meeting that may eventually announce the end of hiking cycle. That's why the market should be very strong indeed in this season, especially with this given seasonality that also favor typically on average favor technology stocks. The previous year was different, but we had back then very strong impulsive move on March that was right corrected, and by April we have just erased that gains, but mainly on a positive right after positive start on Nasdaq. This April used to be relatively good. So also, if you'd like to know where is my where I would put stop loss and where is my stop loss, is right below this low, so it wouldn't be easy to hit them up right now. When you are just entering position right here, just hang on for kind of a consolidation within this area and wait for another chance. I will just maybe redraw it. So I would just try to find any entrance within this box, or even lower the better, but I would expect that it will be difficult for the market to drop below this week, as it's already been defended, and it's coincided with this previous lower high of the directional move. So just await for the entrance within this box, and with a possible objective right at 13.17 at first. That will be the one to hit possibly next trading week. So in my view, we have a risk to reward ratio at around 5 times, so it's quite decent bet on the market, the one that you may really assess to take risk on, but always just adjust your risk to your capabilities and your capital. So that's it in today's episode. Thank you very much for watching, and see you on Monday. Have a great weekend, and just have a chill from charting and get ready for the next very interesting week ahead.